Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Train to talk about round 2 of the Forex Trading 101 series presented by Tackle Trading. This is going to be a weekly ongoing series where we're going to tackle one aspect of the currency market, not too much in depth, just a nice little short video, nice little write-up about the currency market, because I do know that many of you members over there at Tackle Trading want to start getting accustomed to trading currencies and whatnot, and just need some of the basic information out there. So that's what we're here to do, is just really kind of put forth a very basic video about some of the first things that we have to deal with when we talk about the currency market. Now, last week we talked about why Forex. What was the reasons why Forex? What are the benefits of trading Forex? How we trade Forex? Some of the history of the U.S. dollar. This week we're just going to talk about the major currencies. Looking at the major currency pairs, looking at what makes up a major currency, when were they created, how long have they been around. Next week, we'll look into how we specifically trade them, lot sizes, tick values, contract values, and get out there and make some trades in the currency market. Now, there are different types of currency pairs in the currency market. You have major pairs, cross pairs, and then what is considered an exotic pair. Now, the major pairs, these are pairs that consist of the U.S. dollar, because the U.S. dollar is the reserve currency of the world. Anything that consists of the U.S. dollar in the financial transaction is an example of a major pair, such as the U.S. dollar, Japanese yen, euro to U.S. dollar, Australian dollar, U.S. dollar, and so on and so forth. For the most part, this is what we trade. We trade major currencies. It doesn't mean you can't trade other currencies out there. It's just that the major currencies are the most liquid currencies in the world. They're the most utilized currencies in the world. The bid-ask spread is much tighter on a major currency pair than it is on other currency pairs over there. So cross pairs are pairs that do not consist of the local currencies, such as the U.S. dollar, when trading in the United States. So this would be like AUD Japanese yen or Euro British pound, something along these lines that doesn't consist of the U.S. dollar but are still major currencies. And so when you have AUD JPY, that's the Australian dollar Japanese yen pair, because I am here in the U.S. and the pair does not consist of the United States dollar, this is what we consider a cross pair. Cross pairs are not as liquid as the major pairs are. However, they are still liquid enough to get out there and trade. And sometimes in like news-based trades and go-to-bed trades, an AUD Japanese yen pair will be a lot better suited than something like a AUD US dollar or US dollar Japanese yen. And then you have currency pairs that are called exotic pairs, that are made up of a major currency and a currency of an emerging market, such as India or Russia or China or Brazil or whatnot. Some of these emerging market currencies out there that are pitted up against some of the major pairs. So you can trade any currency that your little heart desires. Primarily, we trade the major currencies and the major currency pairs, those that consist of the U.S. dollar in the thing. And that's what the Forex report is all about, is trading the U.S. dollar against the major currency pairs. What pairs are, looking, ripe this week versus next week, and so on and so forth. So let's start with the number one currency in the world, and that is the U.S. dollar. The U.S. dollar was created in 1913. It was named Reserve Currency of the World in 1944, as tied to the value of gold at $35 an ounce, otherwise known as the gold standard, lasted until 1971. 1973, petrodollars started with Henry Kissinger and Richard Nixon making an agreement with Saudi Arabia. That continues until about 1999, where 90% of the world oil market was financed in U.S. dollars. Start to see a little bit of a struggle, though, as China and Russia decide to start moving away from that. That lasts until 2012. The U.S. dollar has lost a lot of muster over the years, ladies and gentlemen. Currently, the U.S. dollar has no complete commodity backing. There are other currencies in the system that do. There's no rule out there that says the U.S. dollar has to be backed by a certain percentage of gold in any capacity, and it truly is, in every essence of the world, a fiat currency, which is a fake currency with no commodity backing. And in looking at this, it's still the number one currency in the world. It's the number one held held reserve currency in the world, which means other nations hold the dollar in reserve to conduct international trade and so on and so forth. The US dollar is directly exchanged against other currencies in what is known as major pairs. Examples are US dollar, Euro, US dollar, Australian US dollar, and so on and so forth. The US dollar is the number one most tradable instrument in the entire world, and it is not close second. The euro was created in 1992. That's when it was first established. It became an international markets in 1999. There are currently 17 member nations in the European Union and 28 nations total that use the euro as its local currency. Very similar to how other like in the United States we use the dollar. In Canada they use the Canadian dollar. The euro was created as a reserve status. It's currently the number 2 held reserve currency in the world at 25% reserve status, in comparison to the U.S. dollar, which is the number 1 reserve currency in the world, with about a 60% reserve status. Those are not the only 2 currencies. All the major currencies are held in reserve. Now, it's the second most held in reserve. It is not the second most utilized currency in the world. We'll get to the Renminbi here in just a little bit. Now, many people for years and years and years, up until about 2009, 2011, thought that the euro would replace the dollar as the reserve currency of the world. And I probably would have said the same thing 5 years ago. However, now we have the European debt crisis. We have Greece and Germany and, France and Italy and the Netherlands all disagreeing on how to approach the European debt crisis, specifically in regards to the Greek situation. They also disagree on monetary policy in terms of quantitative easing, and they disagree on the EU's response to the Ukrainian situation as well. So there are staunch differences within the European Union member nations, and the euro has plummeted over the course of the last year, down about 30% against the dollar and many other currency pairs out there. So the euro, although the second most reserve currency, it's also one of the currencies I am most bearish on right now. Now that does change, and it does change quite frequently depending on how you trade the euro or any other currency for that matter. But I do not see the euro replacing the dollar in any capacity, given the gravity of the problems that the European Union is currently faced with. That brings us to the third most utilized currency in the world, and that would be the Japanese yen. If there's a currency that is under more economic pressure, I do not know of one right now. Speaking of the major currencies, not the cross pairs, not the minor currencies, not the emerging market currencies as well. The Japanese yen was established as far back as 1885 and is widely used in international trade as a reserve currency with Asian nations. Japan is home to the second largest economy and third most liquid currency, but you have had tremendous decades of economic stagnation in the Japanese economy, and this has obviously hurt the Japanese yen. And what the Japanese government is trying to do through Prime Minister Abe and Bank of Japan's Kurado is basically stimulate inflation, get the economy working again. And so they're currently printing 80 trillion yen a year to spark inflation and give their national economy a little bit of a kickstart. They've failed miserably at this so far. Abenomics has been a massive failure in any capacity. I don't know how anybody could say this was what they did in terms of printing money to buy bonds, to buy market-related ETFs, as well as to buy real estate in Japan is nothing outside of absurd. The manipulation is going to be tremendous when it comes to the impact to the Japanese people, the Japanese marketplace, and all they have done is basically hyperinflate their marketplace, and it's really put a lot of pressure on the yen. The yen is currently at 124 yen versus $1 US. The Forex report has been bullish on the dollar against the yen for quite some time, and there's nothing that I see in the chart to take us away from that. So, Japanese yen is probably my most bearish currency out there in the market, with the next currency being the euro. as well amongst the major currencies. So the Japanese yen under some very, very staunch problems here. The next one is the British pound. Now, the British pound has had a very, very rich history. The British pound has held the world's longest utilized currency, literally dating back to the 18th century. From the 18th century until the 19th century, the British pound was utilized in some capacity, but it was also backed by the pound silver, sterling, which is why you hear it referred to as the pound sterling. But it was backed by silver in most capacities up until the early 19th century, when they adopted more of a gold standard versus a silver standard. This lasted until 1914, when the United Kingdom suspended the gold standard due to World War I, and the U.S. dollar became increasingly more popular post World War I, and the pound suffered from that capacity. And they continued to suffer to a certain extent, leading into the decision in 1944 for the U.S. dollar, which was the number one economy at the time, and far exceeded the British economic output. In 1944, the U.S. dollar replaces the British pound as the reserve world currency of the world through the Bretton Woods Agreement. The British do not decide to enter the European the euro. They maintain their currency in the United Kingdom, and many of that is due to just its such rich history for the British pound. Next is the Swiss franc. The Swiss franc prior to 1848, there was no less than 75 different versions of the Swiss currency. However, in 1848, by the act of the Swiss Federal Constitution, they outlawed anybody else from printing the Swiss franc, and basically just the federal government in Switzerland could print the Swiss franc. The franc is seen has seen as a very safe haven currency. This is due to the conservative nature of the Swiss government, as well as the neutrality that the Swiss has maintained both in political, militarily, economic discussions, discords, and negotiations over the better part of the last 2 centuries. The Swiss franc historically has been backed by 40% gold reserve. However, that was changed, and it is now backed by only about 20% gold standard, and it is one of the most safest currencies out there in the market. In the early 2011, the Swiss pegged the Swiss to the euro at $1.20 euro, and maintained that policy for about 3.5 years. However, in January of earlier this year, the Swiss removed the peg and to the euro at $1.20, and created massive panic in the currency market. The Swiss went up against the euro by over 30%, by over 20% against the dollar and the yen. Massive problems associated to what the Swiss was doing with the peg, but I understand why they pegged. It was very important that the Swiss maintain international trade between the European Union, as they do the majority of their trade with their European neighbors, and with the Swiss franc too high in relationship to that, they wanted to make sure that they had pegged it so it didn't get too far away from the $1.20, making international trade a little easier. However, with Mario Draghi, the European Central Bank, coming out there with their own version of quantitative easing, the Swiss basically had to throw in the towel, and that's what they did early January. And so the Swiss, very historically seen as a safe haven currency, and I still believe it is to a certain extent. However, I do not trust the Swiss given what we saw with the pegging and the unpegging. So it's gonna be interesting to see kind of how the Swiss go about the business and monetary policy in this environment where they literally have no peg now, as well as negative interest rates. And so it's going to be interesting to see if the negative interest rates really push away from the other investors out there buying the Swiss franc. But that is the Swiss franc, one of the safest currencies in existence. And then you have two commodity-backed currencies. One is the Australian dollar, that was first established in 1966. It is a commodity-backed currency in the sense that the value of the Australian dollar is very tied and correlated with the value of gold, due to the way their national economies work in terms of mining and whatnot. The Australian dollar typically has a higher interest rate associated to it, so it is a popular currency amongst currency traders and institutions in the carry trade, where you can take the US dollar, euro, Japanese yen, and the Great British pound, sell those major currencies that all have very low interest rates and sometimes negative interest rates, buy the Australian dollar, and then you basically are getting a part of a commodity-backed currency, but you also get to carry the positive interest rate. So it is a popular currency amongst carry traders. The Australian dollar is also highly sensitive to the Chinese economy because 30% of all Australian trade is conducted with the Chinese themselves. The last major currency is the Canadian dollar. It's the seventh largest, most utilized currency in the world, the sixth largest reserve currency in the world, and it's very, very similar to the Australian dollar in the fact that it's a commodity-backed currency. Very, very rich history dating back to the mid 18th century, when in 1867 Nova Scotia, Brunswick, and Canada all merged to form the Canadian dollar. And from 1954 to 1914, the Canadian dollar, much like the Great British Pound, was under the gold standard. However, they no longer are under any standard either. Their economy is tied to mining, which gives it some degree of correlation between gold as well as the Australian dollar. And the last currency I want to talk about is that of the Chinese renminbi. The Chinese renminbi, or RMB, is currently the fifth largest reserve currency in the world, the second most utilized currency in the world. 30% of Chinese trade is settled in RMB. China has made international trade agreements called direct swap agreements to use non-US dollar transactions in international trade. This includes Great Britain, the entire Eurozone, Canada, Japan, Australia, Brazil, Russia, India, South Africa, and that is just to name a few. And all of these agreements read that to use non-US dollar transactions in international trade. At no point in the history of my understanding currencies have I seen a currency in such a short time frame, because prior to 2010, there was none of this. The Chinese currency never backed their own currency, always backed the euro or the dollar. But in 2010, there was a change in the Chinese mentality from a monetary policy, and now they're becoming a massive player on the international stage from a foreign policy perspective, from a currency perspective, from an economics perspective, and their growth is showing that. The SDR, which is the special drawing rights for the IMF, should have the RMB included in the valuation over the course of the next 6 months or so. This is Matt Justice for Tackle Trading, bringing you Chapter 2 of the ongoing weekly Forex Trading 101 series. This is your major currencies. Until next week, Matt Justice for Tackle Trading. Get in the game one trade at a time, and check everything else we do over there at tackletrading.com.